everyone, this is Lisa again of Accounting Wise. How are you today? I hope all is well and good with each and every one of you. Today we will be discussing about the accounting equation. The accounting equation is the foundation of the double entry accounting system, which will be discussed in a separate video. So let's take a look at the accounting equation. It is assets equals liabilities plus capital or stockholders' equity. From this equation, we can deduce the sources of the assets of the business. The liabilities are resources that come from third parties like banks and other financing institutions in which the business borrows money. The capital are resources contributed by the owners to the business. If you will observe, the equation contains what the statement of financial position or the balance sheet contains. That's why the accounting equation is also called the balance sheet equation. Note that assets equals liabilities plus capital or stockholders' equity should be equal at any point in time, which means that if your balance sheet is not balanced, errors must have been made, and we have to find these errors and rectify it at once. You may have to go back to your journals or ledgers to find these errors. Having said that, let's take a look at the XYZ company statement of financial position or balance sheet. This is a vertical view of the balance sheet of XYZ company. So as you can see, the total assets is equals to the total equity and liabilities. Let us put the balance sheet in a horizontal view in order to better understand the balance sheet equation. So if you have with you a calculator, please try to prove the balances of the accounts in the balance sheet, starting from the assets, the liabilities, and capital. As you can see, we can say that the sources of the assets of the company comes from the owner's contribution of 740,000 and from a bank loan of 370,000. So from this, the company bought land and building, property, plant and equipment, and motor vehicles in the amount of 1 million pesos. We can also observe that the business uh, had an inventory or purchase inventory in the amount of 50,000. It sold uh, goods in the amount of 95,000, of which 25,000 is cash and 70,000 it was on account. The bank overdraft is 10,000, which means that they have a negative balance in their cash and bank account. So if we total all the assets, we have 1.145 million, and our liabilities total is 405,000, and our total equity or capital is 740,000. If you add the two, the liabilities and capital, we have the same total with the assets, which is 1,145,000. Okay, so let's put together the accounting equation and the horizontal view of the balance sheet. So total assets is 1.145 million. the liabilities is 405 and the capital or stockholders' equity is 740. So remember, the assets equals liabilities plus capital should be equal at any point in time. From the basic accounting equation, we can derive another equation which is assets minus liabilities equals capital or stockholders' equity. So we have derived another equation from our basic accounting equation. So we have derived this equation, which is assets minus liabilities equals capital or stockholders' equity. So what it means is that if the business decided to pay off all its liabilities, what is left will be the capital or the residual interest of the owners of the business after all the obligations are settled to third parties. We should remember that assets minus liabilities is also equal to net assets. We can therefore say that net assets is equal to capital. Remember that both sides of the equation should be equal at any point of time. So net assets will always be equal to capital or stockholders' equity. So any increase in net assets should also be equal to the increase in capital. We can therefore say that increase in net assets is equal to increase in capital. Please remember that there are only three reasons for changes in capital or stockholders' equity, and these are additional investment by owners, profits during the period, and withdrawals of the owners. These are the only ones that affects the capital account. So from that, we can derive another equation which is increase in net assets equals the capital introduced by the owners plus profits during the period minus drawings or withdrawals during the period. From this equation, we can also compute for the unknown if all the other three are given. For example, to compute for the profit, if profit is not given, the equation would be profit is equals to increase in net assets minus capital introduced plus drawings.